HIMS stock is just stupid. After posting Q2 earnings results with a triple beat in analyst estimates, that's revenue beat, earnings beat, and guidance beat by the way, the stock sold off the following day, which is just stupid. Anyways, my name is Riyado and this channel is all about finding the companies of tomorrow, and in today's video, I'll be covering HIMS Q2 results, valuation, and why I think the stock is stupid. If you want to read the article version of this analysis, you can find the link to my article in the description box below, so definitely check that out. Full disclosure, I do have a position in HIMS, so do stick around to find out what I'll be doing with my position. And with that out of the way, let's jump right into the video. For those of you who are unfamiliar with HIMS and HERS, the company is a telehealth platform that provides consumers access to virtual, high-quality medical care, which includes treatments for hair loss, sexual health, skincare, anxiety, and so on. And ultimately, HIMS and HERS' mission is to help the world feel great through the power of better health. And the company is growing very rapidly, as you can see right here. HIMS and HERS has been growing at 70, 80, 90% each quarter, which is just impressive. In Q2, revenue was 208 million, which is up 83% year over year, and this is a beat on analyst estimates by $3 million. But despite the incredible growth rates quarter after quarter, I expect growth rates to come down over the next few quarters as the law of large numbers starts to put a strain on growth. With that said, strong revenue growth was due to the growth in online channel revenue, which increased 87% year over year to $201 million, driven by the growth in subscribers, average order values, and net orders, which we'll talk about more later. On the other hand, wholesale revenue remains stable with no material growth, but that's not a concern since it only makes up about 3% of total revenue in Q2. And I'm more interested in the growth of online revenue, which is more predictable and have higher margins than wholesale revenue, and we can see that growth in the online channel continues to be robust, which is good to see. As mentioned earlier, one of the major reasons for the strong growth in online revenue was due to continued ads in subscriber count, which as of Q2 was 1.3 million subscribers, which is up 74% year over year. Again, outstanding growth numbers here. But notice that the number of single month subscribers dropped sequentially from 302,000 in Q1 to 291,000 in Q2. This is due to more consumers signing up for multi-month subscriptions as a result of price cuts that management initiated across longer duration and sexual health and HIMS hair loss subscription plans. As such, a meaningful portion of single month subscribers become multi-month subscribers, which grew 97% year over year to just over 1 million subscribers. Keep in mind that the price changes also negatively impacted online revenue by $5 million in Q2, which is why monthly online revenue per average subscriber also dropped 4% quarter over quarter from $55 in Q1 to $53 in Q2. And the rationale behind the price cuts was that management wanted to pass on the savings it achieved from efficiency gains to consumers, as well as to make longer duration subscriptions more attractive for consumers. As a result of the switch to multi-month subscribers, we can see that average order values or AOV accelerated in Q2 to $95, which is up 22% year over year as compared to Q1's 15% growth. On the other hand, growth in net orders decelerated in Q2 to 2.1 million, which is up 52% year over year, which is a slowdown from Q1's 70% growth. That said, HIMS and HERS is in hyper growth mode, and this is a reflection of the company's incredible value proposition as well as management's high-level execution. In addition, I believe management's change in pricing strategy and longer duration plans will pay off in the long run. In fact, I see three major benefits that come out from the shift to multi-month subscriptions. First, multi-month subscriptions have higher average order values, which are paid upfront, which HIMS can reinvest into the business right away. Secondly, multi-month subscribers stay on the platform much longer than single-month subscribers, and this exposes them to other HIMS and HERS products, which increases cross-sell potential. And thirdly, HIMS will save more from packaging and shipping costs as they don't really need to ship out products every single month, which could actually offset margin pressure from the price cuts. Looking at profitability, Q2 gross profit was 170 million, which represents a record 82% gross margin. As you can see, gross margins has been improving over the last few quarters, and this is due to lower product costs, higher efficiency across its provider base, the rapid increase in multi-month subscriptions, higher order fulfillment volume from affiliated pharmacies, which was more than 70% as of Q2, as well as a greater share of online revenue relative to wholesale revenue. Having said that, the high gross margin profile of 80% plus is a major reason why HIMS and HERS can afford to cut prices without hurting its bottom line. And despite cutting prices, gross margins continue to improve, which displays economies of scale within the business. And moving forward, I expect HIMS to cut prices across its entire product portfolio, which should encourage more subscribers into the platform and consequently enable the company to gain even more market share. Jumping straight to the bottom line, we can see that GAAP net income has been improving over the last few quarters, which was negative $7 million in Q2, representing a GAAP net margin of negative 3%. On the other hand, the company is already adjusted EBITDA profitable with Q2 adjusted EBITDA of $11 million, which represents a 5% adjusted EBITDA margin. And as you can see, net margins are tracking adjusted EBITDA margins quite closely, and it won't be long before the company turns GAAP net income profitable. That aside, it's worth mentioning that a great deal of growth depends on elevated marketing spend, but this reflects management's priority to increase brand awareness and maximize new subscriber growth. Nonetheless, you can see how much the company has to spend on marketing to acquire new subscribers, as you can see right here. So as of Q2, year-over-year growth in marketing expenses remains higher than subscriber growth, which is 77% and 74% respectively, and ideally we want to see the opposite as seen in Q1 last year. Management did mention during the earnings call that customer acquisition was slower than usual due to marketing investments being heavily weighted toward the back end of the quarter. With that said, we could see stronger net new subscriber growth in Q3 as marketing investments made at the end of the second quarter provide meaningful tailwinds for customer acquisitions in Q3. But again, it'll be nice to see revenue or subscribers growing faster than marketing expenses. Whatever it is, given the growth of the business as well as the market opportunity ahead, I think maintaining high marketing expenses to acquire as many customers as possible and gain as much market share as possible seems to be the appropriate move. And that's probably why management decided to cut prices so they can accelerate market share gains. That said, margins continue to improve even with the price cuts, which shows operating leverage, and with a high gross margin of 80% plus, the company can afford to cut prices while maintaining high earnings potential, which should reward shareholders in the long run. HIMS and HERS has a strong balance sheet. The company has $193 million of cash and short-term investments with virtually zero debt, and in addition, the company has a current ratio of 4 times, which is liquid and healthy. Inventory looks healthy as well, with inventory pretty much flat over the last few quarters at about $21 million as of Q2. As you can see, inventory has been growing over the last few years, but this is expected as the company builds inventory to keep up with growing demand. But notice that inventory turnover ratio is increasing over the last few quarters and is nearly 10 as of Q2, which means that the company is selling inventory faster, which also means strong demand for HIMS and HERS products. In addition, HIMS continue to improve its free cash flow quarter over quarter. In 2022, free cash flow was negative $29 million, which is a negative 6% free cash flow margin, but in Q2, free cash flow improved to positive $12 million, which is a free cash flow margin of 6%, and this is also a 180-degree flip from last year's negative 6% free cash flow margin. In my opinion, I think we'll see free cash flow continue to improve from here as the company scales further and as the company focuses on profitability. All in all, HIMS and HERS has a very solid balance sheet, and now that the company is free cash flow positive, The company is basically self-sufficient with no need for external financing, which reduces the risk of shareholder dilution. The company is also allocating capital just as it should, reinvesting all its sales and profits back into the business so it can capture even more market share in the fast-growing telehealth market. With a pristine balance sheet and an improving free cash flow profile, I expect capital expenditures to pick up over the next few quarters as the company invests in improving or adding more affiliated pharmacies so they can fulfill orders faster as well as gain full control of distribution. In fact, it's already happening, as you can see by the sudden increase in capex right here. Turning to the outlook of the business, management provided the following guidance. I'm just going to look at the high end of the guidance because HIMS always beat their guidance anyways, so I think there's no point looking at the lower end of the guidance. That's it. As you can see, Q3 revenue is expected to be 222 million, which is a 53% year-over-year growth, and this is quite a deceleration from this quarter's growth of 83%. At the same time, full year 2023 growth is also expected to decelerate from 2022's growth of 94%. That said, management expects 2023 revenue to be 850 million, which is a 61% year-over-year growth. I think the price cuts is one of the major contributors to this slowdown, which management expects a negative impact of between $12 million and $18 million in the second half of the year. Whatever it is, a slowdown in growth is expected since HIMS is now a much larger company. But it's also important to note that full year 2023 guidance was raised by $20 million, which was previously $810 to $830 million. At the same time, full year guidance beat analyst estimates of $831 million, so the company's exceptional quarter of beating estimates and raising guidance just goes to show how strong demand and execution have been. On the other hand, the company also raised full year adjusted EBITDA guidance by $10 million to $40 million, which is a 5% adjusted EBITDA margin due to continued efficiency gains across the business. But despite the raised guidance, management mentioned that their guidance assumes no material contributions from weight management or cardiovascular health in 2023. Also, they're not expecting the extremely favorable marketing environment that emerged in the second half of last year to repeat in the second half of this year. With that in mind, if the company's new products perform better than expected and if the marketing environment turns out better than expected, HIMS and HERS could once again blow past expectations as well as internal guidance. Management do have a history of sandbagging guidance, and I think they're being conservative once again, so I expect more beats and raises in the second half of this year. Regardless, HIMS and HERS has a long growth runway ahead. For one, as much as 90% of the population has yet to seek treatment for some conditions, which means that the healthcare market is highly underpenetrated. And with HIMS offering a fresh approach in healthcare, I think HIMS is well positioned to capture this underpenetrated portion of the massive healthcare market. In addition, HIMS can expand to other categories including testosterone, menopause, eczema, insomnia, and they're also getting ready to launch their weight management product. So lots of potential and market opportunity for HIMS, and this should expand its product portfolio, which should also attract and retain more subscribers as well as increase revenue per subscriber. Another thing worth mentioning is that during the earnings call, management kept repeating the same phrases, which are personalized treatments as well as multi-category treatments. I think those 2 points combined make the company's ultimate growth story, which is to provide high quality, personalized, multi-category medical care at the tap of a button. Here's a quick example. Let's say I have erectile dysfunction, insomnia, acne, and hair loss. Instead of having 4 separate pills to treat those conditions, I can have a licensed provider from HIMS and HERS prescribe me with only 1 pill to treat all those conditions. And this will all be fulfilled and blended by HIMS and HERS. And we already saw this with the recently launched Heart Health by HIMS, which aims to address cardiovascular health and erectile dysfunction with 1 pill. Although this is a long shot, I think this is where the company is heading, and I think this is going to attract so much more people into the platform. Turning Turning to valuation, HIMS trades at an EV to revenue multiple of just 1.8 times, which is way below its peak of 30.6 times and its average of 5.6 times. The lows is at 1.4 times, so HIMS is still trading at the bottom range of its historical multiple. In other words, HIMS is trading very cheaply. But here's the interesting part. I've included some of the company's metrics back when it first went public in Q1 of 2021 as a comparison to today's numbers. As you can see, you can buy HIMS stock at a much cheaper price and valuation despite the company growing revenue by 297%, growing its subscriber base by 263%, improving gross margins by 500 basis points, and turning adjusted EBITDA profitable from negative 16% to 5% today. In other words, HIMS is much cheaper today despite being a much larger, more profitable and fundamentally stronger company, and I think that is just an incredible value for investors. At the same time, when compared to fellow telehealth company Teladoc, HIMS stock looks dirt cheap as well. As you can see, they're both basically trading at the same valuation multiple, even though HIMS is growing 8 times faster than Teladoc. So I think HIMS deserves a higher multiple because of the higher growth rate, and that multiple expansion should drive the stock price higher. But let's turn to my DCF model. As always, for the first 3 years, I will follow analyst estimates and gradually drop revenue growth rates to just 12% by 2032. By 2025, HIMS will achieve $1.27 billion in revenue, which is in line with management's long-term guidance of $1.2 billion plus. Keep in mind that I'm being very conservative with my assumptions here. I think growth rates of less than 20% in 2025 and beyond is very conservative, but I just want to be on the safe side. For gross margins, I'm going to be pessimistic here. I'm projecting gross margins to decline over time to just 75% by 2032, which is a meaningful drop from this quarter's 82% gross margin. The reason for this is that I think competition, product mix, and pricing will put pressure on margins in the long term, but whatever it is, a 75% gross margin is still very high, and it is also still in line with the mid-70s level guided by management. For operating expenses, I expect it to drop as a percentage of revenue over time as the company gains economies of scale, as well as depend less on huge marketing expenses to grow the company. As a result, I expect an operating margin profile of 20% by 2032. And for the rest of the assumptions, I will set them in such a way that I achieve a long-term free cash flow margin of 20.5% for HIMS and HERS. And the reason for this is that management guided for a long-term adjusted EBITDA margin of 20 to 30%, and I think this is a good proxy for free cash flow. But notice that I'm taking the lowest end of the guidance, which is 20%, as my baseline for free cash flow margin for HIMS. Again, being super conservative here. So with these assumptions, I arrive at a revenue of $3.5 billion and a free cash flow margin of 20.5% by 2032, which is extremely conservative in my opinion. And based on a discount rate of 12% and a perpetual growth rate of 2.5%, I get a fair value estimate of $21 for HIMS, which I believe is pretty much maintained from my last video on HIMS. That said, this is much higher than the average analyst price target of $12.90, and based on the current price of $7.18, I see an almost 200% upside potential for HIMS stock. Clearly, I have a strong view that HIMS stock is extremely undervalued right here. But let's look at the price chart and do some technical analysis as well. As you can see, I've drawn a few lines here, including major trends and support lines. And as you can see, the stock dropped after earnings here and is now trading at major support at around $7. So I think the $7 region is going to be a huge battleground between bulls and bears. If $7 fails to hold up, I think we'll see the stock fall to the next major support, which is the uptrend line right here around $6.50, or the major support here, which is around $5.50. And if both fails, I think we can revisit the lows of $4 a share. As for me, I'm planning to dollar cost average on the way down, and I think $7 today is a great opportunity to add to my position. With that being said, I think there's a huge divergence between fundamentals and valuation for HIMS stock. While fundamentals keeps getting better, the stock is getting worse. And instead of rallying after its Q2 triple beat, the stock sold off, and I think that's why HIMS stock is stupid. The stock is stupid, but not the business. And I'm in the business of buying shares of high quality businesses, and I think this divergence between fundamentals and valuation creates a wonderful opportunity for investors to buy shares of HIMS and HERS. Turning to the risks, I think competition is the biggest risk for HIMS and HERS. HIMS and HERS mainly sells generic drugs with no IP protection. As such, there are low barriers to entry, and it's easy for other companies such as Ro, Teladoc, and Amazon to launch similar products. And recently, Amazon announced the national rollout of Amazon Clinic, the company's very own virtual healthcare marketplace. As you can see, here's a screenshot of Amazon's healthcare offerings, which are One Medical, Amazon Pharmacy, and Amazon Clinic. And Amazon is always a threat to other businesses, and we know that Amazon could leverage its massive scale and network, which could take market share away from HIMS and HERS. In addition, Amazon can afford to sell prescriptions at lower prices, which could lead to a price war with other players including HIMS and HERS. Another major competitor is Ro, which offers very similar products and services as HIMS, which could make it difficult for people to choose HIMS over Ro. But I do want to point out that Ro seems to be dealing with a lot of challenges internally. As you can see, Ro's Glassdoor rating collapsed from 4.5 stars a few months ago to just 2.9 stars today. On the other hand, HIMS continue to maintain its high Glassdoor rating of about 4 stars, which is great to see. Culture plays a huge role in the long-term success of a company, and it seems that HIMS and HERS has a stronger culture as compared to Ro, and this could be an opportunity for HIMS and HERS to grow further while Ro deals with its own internal challenges. That said, competition is getting serious, and it could lead to issues such as slowing growth, price competition, as well as health provider supply problems. There are other risks as well, including tightening regulations for telehealth practices, lawsuits against HIMS and HERS, as well as unwanted side effects from HIMS and HERS prescriptions. But that's going to drag the video even longer, so I'm not going to discuss that in detail. But to wrap up the video, I think HIMS and HERS is one of the most attractive investment opportunities you can find today. The company is in hyper-growth mode in a fast-growing telehealth market. The company is also founder-led, with exceptional margin profiles and zero debt on its balance sheet, and the company is getting more and more profitable with each passing quarter. The best part is, while fundamentals continue to improve, the stock is being stupid, and I think this divergence creates a wonderful opportunity for investors to buy shares today, which is what I'm going to do after I upload this video. The stock is stupid, but not the business, and I think it's best to focus on the fundamentals of the business and take advantage of this sell-off. With that being said, what do you think about HIMS and HERS stock? Please let me know in the comment section down below. If you find value in this video, please leave a like, comment, and subscribe to my channel, as it really supports the channel. As always, thank you for watching this video. I appreciate you, and I hope you have an amazing day.